Welcome to EWA's FIN-LYT podcast. EWA is a fee-only RIA based out of Pittsburgh, Pennsylvania. We hope all listeners of this podcast will benefit as we deep dive into complex financial topics that we will make simplified for you. And we hope that this really serves as a catalyst so that you can make the best financial planning decisions for your family and also save time.
This week's podcast, I'm joined with Chris, and we're going to dive into Backdoor Roth IRAs, mega Backdoor Roths, and Roth conversions. So a lot of tax strategies here.
Yeah, let's do it.
Chris, give us the lay of the land of just the tax environment, the tax code.
Yeah, that's a good question because all of this relates back to when you want to pay taxes. We look back historically of where taxes have been. Right now, we're in one of the lowest rate environments we've been at throughout history. So the highest marginal rate's 37%, but that's been much higher in the past. So a lot of opinions are out there on what future taxes will be. Our firm stance is that those will be higher, making Roth more attractive. So we'll get to that today. But yeah, high level, very low right now.
Yeah, and so the tax code that was put in place in 2017, I believe it took effect in 2018, cut marginal tax rates to what you just said, the highest rate's 37. That's set to sunset at the end of 2025. So 2026, if there's no legislation change, that top tax rate goes up to 39.6, and then the tax brackets below that go up a little bit too. So all in all, taxes just by law will be higher. However, that was put in place by the current administration now. So most likely, kind of a big debate in Congress right now and with the government. Probably these tax cuts will get extended, most likely another 4 years. We'll see what happens. But one thing to note before, I believe it was in 2021, after the 2020 election, there was a proposal. It's a big tax overhaul, made it through the House, didn't make it through the Senate. It would have, one big thing it would have done was taken Roth away for anybody that made over $400,000. Wouldn't be able to do Roth conversions, which would inhibit Backdoor Roth, mega Backdoor Roth. So why that's important is our opinion is that, this is in place right now, but this could potentially go away in the future. So all the things that Chris said, taxes going up, potentially Roth could go away. So why, Chris, why is it important, if taxes go up, that you're planning for Roth now?
Yeah, 'cause that's every distribution from a Roth account's tax-free. So if we prioritize pre-tax accounts, that's a good thing while you're working. So you get a deduction. You can remove those savings from your gross income, so your taxable income's lower just in the current year, but all of that's deferred until the future when you're retired and draw that money. So if we fast forward, whether you're 10, 20, 30 years from retirement, those are the tax brackets that we have to try to forecast is what's that environment going to look like when you're actually retired. So if we have too much pre-tax on top of Social Security, if you have pensions, real estate income, anything like that, those pre-tax IRA distributions would be added on top of that and could force you into the 32, 35% brackets depending on your situation.
So one thing, taxes probably will, if I was placing a bet, I would say that they will be higher in the future. So number one, the tax code in general will probably be higher when you're taking money out. Number two, I think a big misconception is that I'll be in a lower tax rate when I'm retired.
Right.
Sometimes that's true. Most of the time, it's not, especially if you have a higher net worth. For all the reasons you just said. Social Security comes in, couple that had maxed that out when you're going to retire. That could be $80,000 to $100,000 a year taxable income.
Right.
85% of that's taxable, but
that
could be an income stream. Maybe you're working part-time, maybe you have real estate income, maybe you have income from different investments. Yeah. And then the big one is dividends or interest that pay from any non-qualified account. So if you're a high income earner, there's limits on how much money you can put into these tax-favored accounts. So majority of your wealth is going to accumulate in a taxable investment account. Mm-hmm. Any dividends or interest that get kicked off now or when you're in retirement shows on your tax return as income. So all of those things, you're already, most likely looking at a couple $100,000 of income on your tax return. And that's before you even take any money out.
Right.
And the other thing too, Medicare costs in retirement are based on taxable income. So if everything's taxable, all of those things plus IRA distributions, you're going to be paying pretty high Medicare rates that you could ideally avoid. And then the other big thing is what's called the sequence of returns risk. So pre-tax IRAs have required minimum distributions. So when you hit age 73, you have to take a portion of the money out because you haven't been taxed on it yet, and the government wants their tax money.
Right.
Roth accounts don't have that. So why that's good is if the market's down and you're forced to take RMDs, you could be forced to liquidate money at a loss, whereas a Roth account, you don't have to take those. You can take the money out whenever you want. If the market's down, you can just choose not to take it out.
Right. Yeah. So your point on the IRA, the RMD, to put it in perspective, if you're 73 right now, if you have 500,000 in a pre-tax account at 73, you'd have to take about 19 out. If you have $1 million, it would be 37, 2 million, 75, or 3 million, 113. That's just in year one. But if
it goes up, that's what people don't understand.
Yeah. So if we look at, let's just use the 2 million example at 73, your RMD would be 75, but by 83, 10 years later, that would go up to 113. So yeah, there's definitely a big misconception that you'll be in a low tax bracket just because you're not working. So if you have a big retirement savings, that's probably not going to be the case. So something we'll talk about today is Roth conversion planning. So there's a sweet spot if you stop working in your 60s before those RMDs start. We can start recognizing potentially some lower tax rates and flip some over to Roth, which we'll get into.
Yeah, so let's talk about how we do that. So the first one, Backdoor Roth IRA. Chris, why don't you give us an overview of what that is?
Yeah, so Backdoor Roth is a strategy that higher income earners can use to fund Roth outside of an employer plan. So IRA stands for Individual Retirement Account. Anyone can establish this as long as you have earned income. But there's limits where, do you know the limit offhand?
It's like $250 for a married couple?
Yeah, so if you make over $250, like if you're a physician, both physicians, we work with a lot of people in medicine, you're probably going to be over that limit. So you can contribute to a traditional IRA on a post-tax basis. You can't deduct that contribution anyways because it's the same limit, that $250. So step one is you put the money in an IRA. You don't get a deduction for it. It's post-tax dollars that you're using. That's an important note because when we do step two and convert that $7,000 to Roth, since those dollars have already been taxed, there's no liability. So once the money's in the Roth IRA, it grows and distributes tax-free. So that's kind of low-hanging fruit that if you have the cash flow to do it, or if you have a brokerage account, we can just move money that's already invested on your balance sheet to fund that backdoor Roth and get more money into the tax-free account.
Yeah, so this is no-brainer if you still have earned income in any capacity. You can fund this. One thing to note is what's called the pro rata rule. So if you have an existing IRA balance, let's say you have $1 million in an IRA and you go to do the backdoor Roth, and you take $7,000, which is the limit if you're under 50 in 2025, you do the non-deductible IRA and convert it. This pro rata rule basically says it's a calculation based on how much money is in the taxable IRA that then makes the Roth conversion taxable. So the money that goes into the Roth becomes taxable. So you don't want to do that. The way around that is either number one, convert your IRA to Roth and then do the backdoor Roth, or move the IRA into your 401k. Now in the IRS's eyes, you don't have an IRA, and then you can fund the backdoor Roth.
Yeah. So that's only, for anyone listening, that's only if you have an existing pre-tax traditional IRA balance. That's where that pro rata or aggregation rule could come into play. You would essentially, your $7,000 Roth contribution would get almost entirely double taxed. It would get taxed once when you earn the money. And then secondly, large portion of that would get recaptured again on your tax return.
Yep.
So,
okay. So backdoor Roth, that's easy, low-hanging fruit, no-brainer if you're able to do it. Now let's talk about, you can fund Roth also through your employer retirement plan. So whether you have a 403b, 401k, the first thing you can do is, we're going to focus on a mega backdoor Roth. But the first thing you can do is make your salary deferral. If you're under age 50, it's $23,500 for 2025. If you're over age 50, you get a $7,500 catch-up. You can make that contribution pre-tax or Roth. So same thing we said, if pre-tax, get a deduction now, Roth, after-tax basis, gross tax-free. A mega backdoor Roth is doing that, but then if your employer offers a after-tax contribution with the ability to do Roth conversions, you can contribute a portion into the after-tax and automatically convert it to Roth. Chris, why don't you give us an example? I don't know, UPMC is a popular one here in Pittsburgh, or AHN. Why don't you give us a breakdown of like specifically how that works?
yeah. So there's something we need to consider. It's called the 415C limit. It's 70,000 total that can go in to a 403B plan or a 401k. So a big misconception that we hear is that the max is 23,500. So that's the case for most plans or most people. But again, if you have access to that after tax account, you can fund above that, above that 23.5 and try to get up to the 70. So an example would be, so if we have 70 total that can go in, say that you're a physician and you get a 3% match, that works on only the first 350 that you earn. So that match would work out to 10,500 that your employer would put in for you. Then we have your elective deferral. That's another 23.5 that could go in. So just between those two pieces, your contributions and the match, we're filling up 34 of the $70,000 limit. So we have 36 left to go. That's where the after-tax contributions would come in. So we would set that up over the course of the year. $3,000 a month or $36,000 for the course of the year goes into that after-tax account. Then we can convert that internally within the plan to the Roth. So end result is we'd have almost $60,000 between your elective deferral and those after-tax contributions that's growing tax-free. And then the only taxable portion would be the employer match. Most 99.9% of employers match on a pre-tax basis. So that's still going to grow tax-free, but when you pull it out, it'll be taxable.
Yeah, so this is very plan specific. Some plans allow you to do this, some plans don't. So important to analyze if you do have this option. If you do, and you're making enough money that you're able to fund all this, another, I would say no brainer while the tax code allows it, because potentially in the future you're not allowed to. And then another strategy to be able to do this, if you have any 1099 income. So let's say you're a physician, you have a W-2 salary from the hospital, and then you do some, consulting or legal work on the side. You can have another 401k through that 1099 income, and you can do the same strategy, make an after-tax contribution, convert it to Roth. So,
Right.
We have clients that are getting 140, 150,000 a year into Roth through Backdoor Roth IRA, Roth 401k or 403B, and then another mega Backdoor Roth 401k if they have 1099 income.
Yeah. Hands down, one of the best things you can do for your planning. The only time we really recommend pre-tax funding is if you have, certain people getting started. Maybe they come out of med school with student debt, and there's certain repayment plans. If your AGI is lower, it's more advantageous. But aside from that, or if you need the extra tax money, like if cash flow wise, you're really banking on that tax deduction from the pre-tax, that's the only reason why we'd recommend it.
Or I've seen a handful of scenarios where people are going to retire in a year or two.
Yeah.
And their income, they're peak earning. Maybe they're making, $500 to $1 million. And then when they do go to retire, maybe before they've turned on Social Security and they don't have any part-time work, they're only going to have $100,000 of income. Maybe we do some deductible contributions and then just because we know in a year or two they are going to be in a lower tax bracket. But that, again, very rare situation that happens. I've only seen that a handful of times.
Right.
Okay, so the third way is through Roth conversion. So Chris, why don't you explain this?
Yeah, Roth conversion planning is just looking at money that's already in a pre-tax IRA and then volunteering to pay the one-time tax to flip it to a Roth IRA. So there's a sweet spot here because we have to look at your tax bracket and where you're at. So for example, say you're married and, between the two of you have, about 80,000 coming in with Social Security. Say there's pension income of 45 or interest income of 20 and your total income's 150 for the year. The way that the tax code's written now, the 22% bracket extends out to 206,000. So we could potentially recognize, look at doing a conversion for about 50 to 60,000. That would keep you in the 22% bracket, and just fill up those low. We mentioned that sweet spot earlier before RMDs start. So we would essentially want to volunteer to pay that tax now, get the money to the Roth, which also reduces your traditional IRA balance. So in the future, those RMDs will be lower.
Basically, you could volunteer to pay 22, knowing that when it comes out with the RMD, you could be paying 35, 37, or a higher rate of tax codes change.
Right. Yeah. This makes a lot of sense if somebody's not maximizing their retirement spending. Like say they have a big brokerage account, they're not maximizing what they could safely take out every year. We could volunteer to pay that tax from that brokerage account because we're still staying in a safe withdrawal rate to just use some of that money that they could otherwise be spending now to make their balance sheet more efficient.
Yeah, and that's a good point too. So one reason you can do Roth conversion is exactly what you said, to pay a lower tax rate versus what it would be later. But another good reason is if you know you're going to have a surplus that's going to be passed on to kids.
Yeah.
Roth accounts pass tax-free. I mean, if you're over the federal estate exemption, the estate credit, you could still pay an estate tax. But when beneficiaries receive that money, they don't pay any taxes when they take it out. So if your kids are in a higher tax bracket, maybe they're also physicians or they're business owners or something where they're making a lot of money. They could inherit that and then pay 37% or higher on it when they take the money out. So where this is, I've seen this really become important if you are over this estate exemption. So right now it's $28 million between a married couple, probably going to go down in the future. Let's say you have a $50 million net worth and a lot of your money is in a pre-tax IRA. Some of that could be subject to a 40% federal estate tax plus state inheritance tax, depending on your state. And then when your kids receive the money, then they pay taxes again on it when they take the money out.
Right.
So, I mean, those are big, big, big numbers. But if you do Roth conversions, maybe you still pay that 40%, but then when they take it out, they don't pay any income tax on it.
Yeah.
So
It could easily be like the federal is 40%. Here in PA, the inheritance tax 4.5%. So if your kid's in the 35 or 37% bracket, we're losing a lot.
80% almost, yeah.
Yeah. So Roth avoids that. Plus if you're inheriting a pre-tax account, that has to come out over a 10-year period.
Yeah.
So there's no way to defer that anymore.
The Roth still has to come out over 10 years if you inherit it, but there's no taxes.
Yeah.
So, if you're over that estate exemption, it's a no-brainer to do Roth conversions, most likely.
Yeah.
Anything we missed?
I don't think so. I think that's the basics of the Roth planning in general. It all comes down to when you want to pay the tax. So, if you have the extra money, if you're retired now, might make sense to convert some money. Definitely we want to recommend prioritizing funding Roth along the way to avoid a lot of complications later on.
Let's talk about one more thing to add. We get this question a lot. How much is too much to fund a Roth?
Yeah.
We would say right now, so general rule of thumb, if you get to retirement, whatever your total assets are, if you have like a third of that in Roth or combination of Roth and taxable account that you're not paying income tax on, you take it out, that's generally good.
Yeah.
More than that's good too. Like some clients want closer to like 50%. Some clients want all their money in Roth just so they don't have to pay any taxes on it.
Yep.
We generally want some money to be pre-taxed because when you do retire, we do want to fill up those low tax brackets. So, Social Security, interest, dividends, any earned any income if you are working part-time. But a lot of times that can be accomplished through what you said, the employer match. Maybe you have a cash balance pension plan that your employer's funding or you're funding yourself.
Yeah.
So most likely if you do all Roth funding, there still is going to be some pre-tax money to fill up those low tax brackets. But general rule of thumb, anywhere between 1/3 to 50% Roth is kind of the sweet spot.
Yeah, that's where it becomes individualized because if you have pension, a lot of pension, but the sweet spot is 10, 12% bracket. No-brainer to recognize income there, but potentially 22, 24, 32, those are the rates that we want to avoid.
Yeah.
Long term.
Yep. So, or even fill up, 22, 24, and then it's a pretty big jump to go up to avoid 32.
Yeah. So,
that's overview on Roth and taxes. Something we're monitoring this year is if the tax code changes, but again, most likely probably will still be in effect for the next few years, but beyond that, totally unknown and could go away. So make sure you're maximizing it now while you're able to. Yeah.
I think a lot of people don't like uncertainty for sure. So that taxes is a huge question mark in everyone's plan. We have no idea what's going to happen, but the Roth is, we know for sure. It takes that away a lot. So
for sure.
Thanks for tuning in to our podcast. Hopefully you found this helpful. Really hope this is as beneficial and impactful to as many people across the nation as possible. So hit the follow button. Make sure to rate the podcast and please share with any friends or family members that would also find this beneficial. Thank you very much.